You're scrolling on Facebook, seeing everyone else living their best life in retirement. You instantly wonder why you aren't doing the same. Maybe you made a mistake somewhere down the line. But how could that be? You've been saving, you've been investing, but there's this nagging feeling that something's off. Here's what nobody tells you. The difference between rich and poor retirees isn't just about how much you save. It's about what you avoid buying. The 10 assets I'm about to reveal create the wealth gap between retirees who thrive and those who struggle. The good news is that you don't have to wait until retirement to start thinking like a wealthy retiree. The identity shift starts right now. Make sure to hit that subscribe button and give this video a thumbs up if this helps clarify your retirement strategy. Let's start with the biggest trap I see struggling retirees fall into, and you're probably not going to like this one. Timeshares. On the surface, they sound smart. A guaranteed way to have vacations, a place to make family memories, something that commits you to actually taking that trip every year. It feels like you're locking in your travel costs and building something permanent. But here's the thing they're missing. Timeshares aren't assets. They're liabilities dressed up in vacation clothes. Once you sign that contract, you're stuck with maintenance fees that increase every single year, special assessments that pop up whenever the property needs repairs, and exchange costs if you want to go somewhere different. And if you ever try to get out, the resale market is practically worthless. I've seen people try to sell timeshares for $1 just to escape the annual fees. Wealthy retirees understand something crucial. Flexibility is more valuable than forced commitment. They rent where they want, when they want, and they keep their money liquid and working for them instead of tied up in a contract that becomes another annual obligation they can't escape. Now let's talk about vacation homes, because this is where the math gets really interesting. The dream sounds perfect. A beach house, a mountain cabin, a place where your family gathers and creates memories. But here's what most people don't calculate: the true cost of ownership. Let's break this down. You've got the mortgage or the purchase price, sure, but then there's property taxes, which never stop, insurance, which keeps climbing, utilities that run year-round even when you're not there, repairs and maintenance, because properties don't maintain themselves. And here's the part that blows people's minds: the opportunity cost of that capital. Think about it this way. If you have $300,000 tied up in a vacation home that you use maybe 4 weeks a year, that's $7,500 per week before you even factor in the ongoing costs. You could rent luxury accommodations anywhere in the world for that price and still have your $300,000 invested and growing. But here's the psychological trap. Ownership feels like status. It feels like you've made it. And that feeling is expensive. Wealthy retirees make a different calculation. They ask, does this property serve my retirement goals, or does it just make me feel successful? The usage reality is even worse than most people admit. You think you'll use it every month, but then life happens. Work gets busy, health issues pop up, grandkids have schedules, and suddenly that vacation home sits empty 11 months a year while you're still paying for everything. The wealthy retiree approach is simple. Rent luxury when and where you want it, keep your capital liquid and working for you in investments that actually grow, and avoid the headache of managing a second property. The identity shift required here is massive. You have to move from ownership as status to flexibility as wealth. And that shift separates people who retire comfortably from people who retire broke. But timeshares and vacation homes are obvious traps once you run the numbers. The next category is where things get really interesting, because financial advisors are actually selling these to you as solutions. So insurance and vacation properties drain your cash flow in obvious ways. But the next trap is even more insidious because it comes wrapped in promises of security and guaranteed income. Let me introduce you to the insurance and annuity industrial complex. High-fee annuities are the financial product equivalent of a magic trick. The promise sounds incredible: guaranteed income for life, protection from market volatility, peace of mind in retirement. But here's what's actually happening behind the curtain. Someone is getting rich from this arrangement, and it's probably not you. Let's decode the fee structure, because this is where things get wild. You've got surrender charges that lock up your money for 7 to 10 years, mortality and expense fees that run 1 to 1.5% annually. Administrative costs, rider fees if you want any additional features. And here's the kicker. These fees compound against you year after year, eating away at the returns you thought you were getting. The liquidity trap is even worse. Your money is locked up with steep penalties for early withdrawal. If you need access to your cash because of an emergency, you're paying through the nose to get your own money back. That's not security. That's a financial prison. Let me tell you about a woman we met a few years ago. She had the majority of her savings in a variable annuity with an income rider. Got it from an advisor at a bank down the street. Sounded sophisticated. Sounded safe. But here's what made this situation absurd. Her pension and Social Security already covered all her living expenses. She didn't need the income. Her actual goal was to leave money for her son as a legacy. This annuity was the exact opposite of what she needed. It was designed to convert her assets into income, but she already had income covered. She wanted growth and legacy planning. But she was locked into this contract, paying fees every year for a feature she didn't need and couldn't use effectively. Now let's talk about whole life insurance, because this is where insurance pretends to be an investment and fails at both jobs. To be fair, whole life can make sense in very specific situations. If you start a policy when you're 25 years old, it has decades to build cash value. Or if you're later in life and you need a small final expense policy to cover burial costs, that's a legitimate use. But here's the problem. These policies are being pitched to people in their 50s and 60s as retirement tools. And the math just doesn't work. It takes decades for a whole life policy to build meaningful cash value. By the time most people buy them later in life, they don't have those decades for the policy to actually work for them. Let's break down what you're actually paying for. You've got the premium, which is significantly higher than term insurance. You've got policy fees. You've got the cost of insurance, which increases as you age. And all of this is coming out before any cash value starts to accumulate. So instead of providing retirement security, these policies become expensive, illiquid commitments that drain cash flow during the exact years when you need that money working hardest for you. The wealthy approach is simple. Keep insurance separate from investments. Let insurance do its job of protecting against catastrophic loss. Let investments do their job of growing wealth. Don't try to force one product to do both jobs badly. The identity shift here is crucial. Stop buying products that sound sophisticated and start asking one simple question. Does this actually solve my specific problem? Because here's what I've noticed. The more complicated a financial product sounds, the more likely it is that the complexity benefits the person selling it more than the person buying it. So, insurance and annuities create expensive, illiquid commitments that lock up your money and limit your options. But the next trap is even more seductive, because it feels like you're building real, tangible wealth. Real estate feels tangible. You can touch it, see it, drive past it. And that's exactly why it's such an effective trap. Let me introduce you to the rental property fantasy that keeps struggling retirees broke. The pitch sounds incredible. Passive income that flows in every month while you sleep. Build equity while tenants pay your mortgage. Create generational wealth through real estate. It's the American dream wrapped in property deeds and rental agreements. But here's the reality check nobody wants to hear. Rental properties are about as passive as a second job. Vacancies eat into your income. Repairs pop up at the worst possible times. Tenant management becomes a part-time gig you never wanted. Property taxes keep climbing. Insurance costs increase every year. And if you think you can just hire a property manager to handle it all, congratulations, you just gave away most of your profit margin. The time cost is what really gets people. Being a landlord means 3 a.m. phone calls about broken water heaters. It means dealing with late rent payments and eviction processes. It means managing contractors and handling maintenance emergencies. That's not a retirement income stream. That's a business that demands your attention exactly when you're supposed to be enjoying your freedom. Let me show you the math that changed everything for one of our clients. She lives in Texas but owns a rental property in California. She's got about $550,000 in equity tied up in that property. Her net rental income after all expenses? $15,000 per year. Now here's where it gets interesting. If you wanted to generate $15,000 in annual income from a properly diversified investment portfolio, how much would you need invested? At a 4 to 5% withdrawal rate, you'd only need between $300,000 and $375,000. Think about what that means. She could sell the property, take her $550,000 in equity, invest $375,000 of it to generate the same $15,000 income, and still have $175,000 left over. No tenant headaches, no repair emergencies, no property management stress, just clean, simple income from investments that don't call you at midnight. But here's the psychological trap that keeps people stuck. Selling feels like giving up. It feels like admitting defeat. Real estate is supposed to be the path to wealth, right? So letting go of that property feels like you're losing something valuable, even when the math clearly shows you're losing money by keeping it. Rental properties can work, but only when you treat them like a business with professional management and clear profit margins. Not as an emotional decision based on the idea that real estate always goes up, or that being a landlord makes you wealthy. The wealthy retiree lens is different. Every real estate decision runs through the financial calculator first. Does this property generate better returns than alternative investments? Does it require my time and attention in ways that reduce my quality of life? Is the equity working as hard as it could be? The identity shift required here is massive. You have to move from I own property to does this property actually serve my retirement goals? Because ownership without purpose is just expensive pride. Real estate feels tangible, but the next category is where people get burned chasing something that sounds safe but isn't. Let me introduce you to the yield chase and why it destroys more retirement portfolios than most people realize. High-yield bonds sound like the perfect solution. You want income in retirement, right? You need cash flow to pay your bills. So when someone shows you bonds paying 7, 8, 9% interest, your brain lights up. That's way better than the 3 or 4% you're getting from investment-grade bonds. More income means more security, right? Wrong. Here's why they're called junk bonds. These aren't bonds from stable companies with strong balance sheets. These are bonds from companies with serious financial problems, companies that might not be able to pay you back. The higher interest rate isn't a gift. It's compensation for the very real risk that you're about to lose everything. And here's the timing problem that makes this trap even worse. Defaults spike exactly when the economy tanks and you need that income most. So you're getting those nice fat interest payments when times are good, feeling smart about your income strategy, and then the recession hits. Suddenly the companies behind those bonds start defaulting, your income stream disappears, and you're left with losses at the exact moment when you can't afford to take them. The set it and forget it trap is what really gets people. They buy these bonds thinking they're building a safe income portfolio, then they stop paying attention. But high-yield bonds require active monitoring. You need to watch credit ratings, track company performance, understand when to sell before defaults happen. That's not passive income. That's active management disguised as bond investing. The wealthy approach is completely different. They let stocks provide growth over time. They let high-quality bonds provide safety and liquidity when they need it. They don't try to force bonds to behave like stocks, or stocks to behave like bonds. Each asset class does its job, and the portfolio works as a system instead of trying to engineer returns from the wrong places. Now let's talk about structured products, because this is where complexity becomes a sales tool. The pitch sounds incredible. Market-like returns with downside protection. You get to participate in stock market gains, but if the market crashes, you're protected. It sounds too good to be true because it is. Let's decode what's actually happening. These products come loaded with opaque fees buried in the fine print. Limited liquidity means you can't easily get your money out. And the risks? They're written in legal language that would take a securities lawyer to fully understand. The complexity itself should be a massive red flag. Here's my red flag test, and I want you to remember this. If you can't easily explain how your money is invested to a friend over coffee in under 2 minutes, you probably shouldn't be invested in it. Because if you don't understand it, how can you possibly know if it's working for you or against you? And here's who actually benefits from these products. The company selling them. They get paid up front through embedded fees. They get paid ongoing through management costs. They make money whether you make money or not. That's not an investment designed for your benefit. That's a product engineered to generate revenue for the financial institution. The wealthy retiree principle is simple. Simplicity is a feature, not a flaw. Clarity beats complexity when you're protecting your money. You don't need exotic financial engineering to build wealth. You need boring, transparent, low-cost investments that do exactly what they're supposed to do without surprises. The identity shift here is moving from "this sounds sophisticated" to "I understand exactly where my money is and what it's doing." Because sophistication in financial products usually just means someone's making money off your confusion. High-yield bonds and structured products try to engineer returns through complexity. But the next trap is even simpler and more widespread, and it's probably sitting in your retirement account right now. High-yield bonds and structured products try to engineer returns, but the next trap is even simpler and more widespread. It's probably sitting in your retirement account right now, quietly destroying your wealth through fees and underperformance. Let me introduce you to actively managed mutual funds. The promise sounds reasonable. Professional stock pickers who spend all day analyzing companies, making trades, beating the market. You're paying for expertise, for someone smarter than you to manage your money. It feels responsible. It feels like you're taking your retirement seriously by hiring the professionals. But here's the reality that the financial industry doesn't want you to see. The majority of actively managed funds underperform the market after fees. Not some of them, not a few bad apples, the majority, and the fees are what kill you. Let's break down what you're actually paying for. You've got the management fee, usually 1 to 2% annually. You've got trading costs every time the fund buys or sells securities. You've got commissions. And then there's the tax drag, because all that trading creates taxable events that eat into your returns even more. 1 to 2% doesn't sound like much, right? But here's where the compound effect becomes devastating. Let's run the numbers. You've got $1 million invested. If it grows at 7% annually over 30 years, you end up with $7,612,000. But if you're paying 2% in fees and your actual return is only 5%, you end up with $4,321,000. That 2% fee just cost you $3,291,000 over 30 years. That's not a rounding error. That's the difference between a comfortable retirement and a wealthy one. The index fund alternative is boring, and that's exactly why it works. Lower costs mean more of the market's returns stay in your pocket. Lower trading activity means lower tax drag. Market matching returns mean you're not gambling on some fund manager's ability to pick winners. The wealthy retiree math is simple. Keeping more of your returns compound significantly over decades. They're not trying to beat the market. They're trying to capture the market's returns while minimizing the costs that destroy wealth. But here's where it gets really interesting. Many advisors are incentivized to sell actively managed funds because of higher commissions. They make more money when you pay more in fees. The conflict of interest is built right into the business model. Let me tell you about an advisor I talked to recently. He's trying to leave his firm because their business model is to put 50% of every client's money into annuities. Not because it's best for the client, because it generates the highest commissions. He couldn't stomach it anymore, so he's moving to a fee-only firm where the incentives actually align with client outcomes. You have to watch out for firms that are pushing products instead of building strategies. Because when the business model depends on high-fee products, guess what you're going to get recommended? The identity shift here is crucial. Stop thinking, I need someone to beat the market for me, and start thinking, I need to keep more of the market's returns. The real question isn't whether your fund manager is smart. The real question is, what is this costing me in opportunity cost? Now that you understand what wealthy retirees avoid, let's talk about what they actually do instead. Now that you understand all these traps, let's talk about what wealthy retirees actually do instead. Because avoiding bad investments is only half the equation. The other half is building wealth through the right approach. The core principles are simple. Low cost, transparent, tax efficient, and liquid. Those 4 words separate wealthy retirees from struggling ones. Let me break down what each one actually means in practice. Low cost means you're not paying 2% in management fees or getting nickel and dimed by product charges. Wealthy retirees use low-cost index strategies that give them broad market exposure without the fee drain. They understand that every dollar saved in fees is a dollar that compounds in their favor over decades. Transparent means you know exactly where your money is and what it's doing. No complex structured products with risks buried in legal documents. No annuities with surrender charges hidden in the fine print. You can explain your investment strategy to a friend in under 5 minutes, and that clarity gives you control. Tax efficient means you're not creating unnecessary taxable events through constant trading. Wealthy retirees focus on total return strategy, not yield chasing. They let their investments grow with minimal tax drag, and they're strategic about when and how they take distributions to minimize the tax bite. Liquid means your money isn't locked up in contracts or properties that take months to sell. You have flexibility to access your capital without penalties or restrictions. Life changes, opportunities arise, emergencies happen. Liquidity gives you options, and options are valuable. Here's what this actually looks like in practice. Wealthy retirees build portfolios around broad market index funds with expense ratios under 0.2%. They maintain a mix of stocks and high-quality bonds that matches their risk tolerance and time horizon. They keep enough in cash or cash equivalents to handle emergencies without being forced to sell investments at the wrong time. They don't chase yield. They don't lock into long-term contracts. They don't buy complexity. They keep things simple, clear, and under their control. The right team matters too. Wealthy retirees work with advisors who prioritize outcomes over commissions. Fee-only models where the advisor gets paid for advice, not for selling products. People who design strategies around your actual goals instead of whatever generates the highest commission check. The psychological shift is the hardest part. You have to move from being a product buyer to being a wealth builder. That means saying no to the vacation home that feels like status. It means walking away from the annuity pitch that sounds sophisticated. It means choosing boring index funds over the actively managed fund with the impressive track record. The identity transformation doesn't happen overnight. You don't become a wealthy retiree by accident. You become one by making different decisions. Starting today. Not tomorrow. Not next year. Today. Here's the choice framework that wealthy retirees use for every financial decision. They ask 3 questions before buying anything. Does this keep my money liquid and working? Does this minimize costs? Does this align with my actual retirement goals? If the answer to any of those questions is no, they walk away. It doesn't matter how good the sales pitch sounds. It doesn't matter if their neighbor just bought one. It doesn't matter if it feels like they're missing out. They walk away. The opportunity cost lens is what really separates wealthy thinking from poor thinking. Every time you tie up money in a vacation home or a high-fee annuity or a rental property that's more headache than income, you're choosing that over investments that could be compounding quietly in the background. That $300,000 in the vacation home, over 30 years at 7%, that's $2,287,000. That's the real cost of the beach house. That's what you're giving up for the privilege of owning property you use 4 weeks a year. The real wealth gap isn't about earning more. It's about keeping more by avoiding these 10 traps. But it's also avoiding these 31 items that are no longer worth your money in retirement.